Imagine standing on a stage, right? And you're telling a room full of Wall Street analysts.
Which is a really tough crowd, by the way.
Oh, an incredibly tough crowd. And you tell them, point blank, that the total global market for personal computers is going to shrink by nearly 20% this year.
Yeah, just casually dropping a massive bomb like that.
Right. But then, in the exact same breath, without even missing a beat, you confidently raise your annual profit guidance.
It sounds like, I don't know, absolute financial alchemy.
It really does. You're basically telling the world, hey, the pie is shrinking dramatically, but we're somehow going to take home a much larger slice.
Yeah, and on the surface, it sounds completely contradictory, maybe even a little arrogant, right?
Totally.
But when you actually look at the underlying mechanics of how they're pulling it off, it reveals this really profound shift in how consumers and enterprises are behaving right now.
Okay, let's unpack this. Welcome to another Talk Tickers edition of the deep dive into the source material.
Glad to be here.
Our mission today for you, the listener, is to cut through the dense, sometimes totally impenetrable Wall Street jargon and completely dissect HP Inc.'s second quarter 2026 earnings conference call.
It's ticker HPQ for anyone tracking at home.
Exactly, HPQ. And we're putting a very data-forward, highly opinionated, and actionable lens on this today. We want you to walk away knowing if these latest results signal a real long-term advantage, or if there's, a hidden structural weakness lurking under the hood here.
And this is just a uniquely pivotal moment to look at this specific company. HP is navigating this massive tectonic shift in technology.
The AI wave.
Right, arguably the biggest shift since we went from desktop to mobile. And they're doing it under transitional leadership, which is wild.
Yeah, that's a huge point. We're talking about interim CEO Bruce Broussard and CFO Karen Parkhill. They are steering this massive ship while the board is actively hunting for a permanent replacement.
Which just adds such an incredible layer of complexity to the whole thing. Right. I mean, it's one thing to pivot a company when you're the founder or a tenured CEO with the board's total confidence,
Oh, for sure. You have that runway to make mistakes.
Exactly. But it is quite another thing to execute a flawless global pivot while you're effectively acting as a substitute teacher.
That is the perfect analogy, and that's the core tension I want to focus on. Think about these legacy hardware companies. These are the old school pillars of Silicon Valley.
Yeah, literally founded in a Palo Alto garage in 1939.
Right, and countries with that kind of history, they're like giant cargo ships. They are notoriously difficult to turn quickly.
Very true.
But somehow, if we believe this earnings transcript, HP is attempting to just completely re-engineer its DNA on the fly to surf this massive, fast-moving wave of artificial intelligence.
Yep.
So the big question for today is it actually working? Can a traditional printer and PC company really transform into an AI powerhouse?
Well, to answer that, we have to ground ourselves in the raw data. Yeah. Right. Because the story doesn't matter at all if the numbers don't back it up.
Exactly. Show me the money. Let's get into the headline numbers. What actually happened this quarter?
So looking at the absolute top-level data, HP delivered what I think can only be described as a surprisingly robust performance.
Okay, define robust for me here.
They reported that top-line revenue grew 9% year over year.
Wow.
Yeah, for a mature hardware company in what is frankly a challenging macroeconomic environment, that is a highly respectable figure. And more importantly, it's their 8th consecutive quarter of top-line growth.
But hold on a second. I got to play devil's advocate. 9% top-line growth in hardware feels suspiciously high to me right now. Are they actually selling 9% more physical computers, or is that number being inflated by something else?
That is exactly the right question to ask. And CFO Karen Parkhill actually addressed it right out of the gate using a classic piece of Wall Street jargon.
Which we are going to translate.
Right. She clarified that revenue grew 9% year over year, or, quote, 6% in constant currency.
Okay, let's break down constant currency for the listener. Companies throw this phrase around on literally every earnings call, but it really changes how you view the results.
It completely alters the picture. So HP is this massive multinational beast, right?
Right.
They're sourcing parts from Taiwan, assembling in Mexico, selling to enterprises in Germany, Japan, the UK. So they are doing business daily in euros, yen, pesos, you name it.
But they're a U.S. company.
Exactly. So at the end of the quarter, they have to translate all those global sales back into U.S. dollars for their earnings report.
And those currency markets are just constantly moving.
They never stop. So if the US dollar suddenly gets really strong against the euro, the laptops they sell in Europe look like they brought in less money when converted back to dollars.
Even if they sold the exact same number of laptops?
Precisely. The revenue looks like it shrank just because of exchange rate math, not actual business performance. And a weak dollar does the exact opposite. It artificially inflates the revenue.
So when she says a constant currency growth rate of 6%,
She's stripping out all that foreign exchange noise. She's saying, look, if currency rates had just stayed perfectly flat from a year ago, our underlying core business volume still grew by a really healthy 6%.
got it. Okay, so it gives you the true operational demand. 6% core business growth is a very clean, solid number.
It is.
But the metric that genuinely jumped out at me was the bottom line. Let's talk about earnings per share, or EPS.
Oh yeah, this is where it gets really interesting.
Right. Their non-GAAP diluted net EPS hit $0.86. That is a jump of over 20% year over year.
It's massive.
Not only did it grow 20%, but it comfortably beat their own internal guidance. How does that happen?
This is where you see the true financial engineering of this management team at work. Think about the relationship between those two numbers we just talked about.
The 6% and the 20%.
Exactly. You have top line constant currency revenue growing at 6%, but bottom line profit growing at over 20%.
That's a huge gap.
It is. In the hardware sector, which, let's be honest, is a highly commoditized, very low margin arena, seeing that kind of divergence is just an astounding flex of operational leverage.
Okay, and for the listener, operational leverage essentially means they're increasing their profits at a much faster rate than their revenue, usually because they're keeping their fixed costs incredibly tight.
Exactly right. It tells us they aren't just, blindly pushing more boxes out the back door. They are getting remarkably more efficient at monetizing every single transaction.
Squeezing every penny out of the process.
Right. They're holding overhead steady, they're managing manufacturing costs, and they're just maximizing the profit yield on every laptop that ships.
You really see that leverage clearly when we split the business into its two main wings, because HP is really two completely different companies operating under one roof, right?
Probably. It's personal systems and print.
Exactly. Personal systems, which is your laptops, desktops, workstations, and then the print segment. Let's look at personal systems first, because they were definitely the star of the show this quarter.
The engine pulling the train, for sure.
Revenue in the PC division jumped 13% year over year, and it wasn't just a consumer fad. It was super balanced. Commercial sales were up 14%, and consumer was up 10%.
Which is great to see.
And then their operating margins for this segment hit 5.2%. Now, I want to play devil's advocate again here.
Go for it.
If you look at software companies, a 5.2% operating margin would literally get a CEO fired on the spot.
Yeah.
Software companies brag about margins in the 70 or 80% range.
Oh, easily.
So why is Wall Street giving HP a standing ovation for a 5.2% margin in their PC division?
Because you have to respect the physical realities of the hardware industry.
Yeah.
Selling software is basically magic. You write the code once, and you distribute it infinitely over the internet at near zero cost.
Right. It's just pure profit after development.
Exactly. But building a physical computer, that requires mining silica, fabricating semiconductors in multi-billion-dollar foundries, assembling delicate parts in a factory.
Putting them on massive containers.
Yes. Warehousing them, distributing them to Best Buy or whoever. You are constantly fighting supply chain chaos, raw material prices, freight rates, and just brutal price wars with companies like Dell and Lenovo.
It's a knife fight in a phone booth.
It really is. So in that environment, maintaining a 5.2% operating margin is a testament to extreme discipline. It actually beat their own expectations.
Because they aren't just selling cheap Chromebooks, right?
Exactly. It shows they are successfully selling higher tier premium devices where they can actually command a markup instead of just racing to the bottom with budget laptops that make zero profit.
Okay, that makes total sense. And it makes the contrast with their other division even more wild. Let's look at the print segment.
The print division.
Revenue here was completely flat year over year. I'm talking 0% growth. Nothing.
Flat as a pancake.
But reading the transcript, management wasn't panicking at all. They expected this flat line. And despite having literally zero top-line growth, the operating margin in the print division was an unbelievable 18.3%.
Which is just staggering for hardware. That 18.3% margin is the secret engine behind HP's entire corporate strategy.
Let's dig into that.
Now, to be totally precise with the data, that margin is technically down slightly from last year, which they blamed on some promotional investments and weird trade-related costs. But even slightly down, print is an absolute cash cow.
Because of the razor and blade model, right?
Exactly, the classic razor and blade economics. HP will gladly sell you the physical printer hardware at a super low margin, or sometimes they even take a loss on that initial box.
They don't care about the printer.
Not at all. They make their staggering 18+% margins on all the recurring stuff you have to buy for the next 5 years. The specialized ink, the proprietary toner, the special paper.
And now the subscriptions, like that HP Instant Ink program.
Yes, where the printer literally monitors its own ink levels and orders a refill from HP before it runs out.
It just locks you right into a monthly fee.
It's brilliant. It turns a sporadic one-time hardware purchase into a highly predictable, software-like recurring revenue stream.
So having flat revenue but an 18% margin means print is just quietly sitting in the corner generating mountains of free cash flow.
Which HP absolutely needs to fund their aggressive R&D and expansion over on the PC side.
Okay, so we've got the headline numbers painted clearly, 8 quarters of revenue growth, insane operational leverage driving a 20% EPS spike, a surging PC business, and a cash printing printer business.
Pun intended.
Always. But this leads us to section 2 of our Talk Tickers deep dive. The story behind the numbers. Why did this happen?
Right. What's the actual driver here?
Because in a year where consumer spending is super tight and corporate IT budgets are getting slashed, how did they pull this off? What is the catalyst?
The catalyst is, without a doubt, a profound architectural shift in hardware. And it can be summed up in 4 letters. AI PC.
The AI PC. It feels like such a marketing buzzword lately.
It totally was a buzzword a year ago, but now it's showing up tangibly right there in HP shipment data.
Give me the numbers on that.
According to CEO Bruce Broussard, AI-enabled personal computers went from representing 35% of HP's total shipment mix last quarter to 44% this quarter.
Wait, 44%? Nearly half their computers are AI PCs now.
Yes, that is a massive sequential leap in just a few months. And their management projects, this will hit 60% to 70% of their total mix by next fiscal year.
Okay, we need to pause and define what an AI PC actually is, because honestly, I can open Google Chrome on my dusty 10-year-old laptop, go to ChatGPT, and use AI.
Right, anyone could do that.
So what makes an AI PC fundamentally different? Why is a Fortune 500 company paying a premium for these new boxes?
The difference is entirely in the physical hardware architecture. When you use a web-based AI on an old laptop, your computer is basically just a dumb terminal.
It's just a window to the internet.
Exactly. You type a prompt, it travels over the internet to some massive multi-billion-dollar Microsoft or Google data center. Their GPUs do the hard work and send the text back to you.
So the cloud does everything.
Right. But an AI PC is built completely differently. It has a specialized piece of silicon called a neural processing unit, or NPU.
NPU, okay.
It's baked right into the processor, sitting right next to the traditional CPU and GPU. And this NPU is purpose-built to run complex machine learning models directly on the laptop itself.
Without needing the internet at all.
Exactly.
Okay.
No internet required.
So it's the difference between like having a master chef cooking directly in your own kitchen versus trying to order delivery from a restaurant across town during rush hour.
That is a phenomenal analogy. And it perfectly captures why the industry is aggressively shifting toward what they call edge computing.
Edge computing? I saw Broussard talking a lot about that on the call.
He spent a ton of time on it because for the last 2 years, the whole AI story has been about the cloud. But we're hitting a wall with that.
What kind of wall?
Well, Broussard talked about agentic AI. These are AI systems that don't just answer questions, but actively take over your software to do complex workflows for you.
Like formatting an entire Excel model while you watch.
Exactly. Running that level of AI constantly in the cloud is becoming financially impossible at scale.
Because of the token costs.
Right. Every single word an AI reads or writes in the cloud costs a fraction of a cent.
Which sounds cheap until you scale it up.
Imagine a company with 10,000 employees using AI all day, every day. The monthly cloud bill from Amazon or Microsoft would be astronomical.
So shifting it to the local NPU kills the token cost. That's huge.
It's huge. But cost is only the first pillar. The second is latency. If an AI is helping you in real time, like transcribing a live meeting or analyzing a video feed, you can't have the lag of sending data to a server in Virginia and back.
It ruins the real-time experience.
Right. The local NPU processes it instantly. Zero lag.
And the third pillar, I'm guessing it has to do with corporate paranoia.
You nailed it. Security and privacy. This is the absolute deal breaker for enterprises.
Yeah, I mean, if you're a hospital system or a defense contractor or a giant law firm,
you cannot upload classified or highly proprietary data to a public cloud server. Period. The risk of a data breach is way too high.
the lawyers would have a heart attack.
Exactly. So these enterprises, they desperately want the productivity boost of AI, but they demand total control of their data. Edge computing is the only way to do both.
Put the AI inside the corporate firewall.
Yes. Keep it localized on a highly secure HP workstation. That's why HP is seeing double-digit growth in their high-end Z workstations. They are literally miniaturizing the data center and putting it on the employee's desk.
And they talked about some wild new features to support this at their HP Imagine event.
Oh yeah, the new tech is fascinating.
They mentioned HP NearSense, which uses spatial intelligence, so devices just intuitively connect based on how physically close they are. And then AI Producer, which uses the local NPU to turn a basic laptop into a live production studio.
Doing real-time video summarization, background rendering, transcription, all without melting the battery.
Right, so they're building this whole orchestration layer that bridges the local hardware with the cloud.
And we can't forget how this edge philosophy spills over to the print division. They launched these new LaserJet printers with AI document workflows built natively into the printer.
But the craziest part was the security feature they mentioned.
The quantum resistance.
Yes, quantum-resistant cryptography on an office printer.
It sounds like pure science fiction.
It really does. Why does my printer need to fight off quantum computers?
Because hackers use networked printers as a vulnerable backdoor into enterprise networks all the time. HP is basically future-proofing these devices against next-gen quantum cyber attacks.
Unbelievable. Okay, so the AI edge computing narrative is incredibly strong, but there's also a very boring mandatory structural catalyst happening right now that's forcing IT departments to buy new computers.
The Windows 11 refresh.
Exactly. The transcript showed massive regional spikes. Asia was up 18% in constant currency, Europe up 6%. And management flat out said this is because corporations are finally opening their wallets to replace their aging fleets.
It's a forced march. They don't have a choice.
Because Microsoft is pulling the plug on Windows 10 support.
Right. Microsoft drew a line in the sand. If you run a Fortune 500 company, you simply cannot operate on an unsupported operating system.
No, security patches means you're just begging for a ransomware attack.
Exactly. So they are legally and functionally compelled to buy new machines that meet the hardware specs for Windows 11. And the stat that blew my mind on the call was that roughly 30% of the enterprise installed base is still sitting on Windows 10.
30%. That is a colossal number of machines that absolutely must be replaced soon.
It's like knowing 30% of your global customers hold an expiring coupon they are legally forced to use. It's a massive runway for guaranteed demand.
Okay, here's where it gets really interesting, though, and this moves us into the headwinds. To build all these premium AI PCs, HP needs highly specialized parts.
Yeah, advanced chips, tons of memory, solid-state storage.
And across the whole global supply chain right now, the costs for those specific components are skyrocketing.
They are going straight up.
CFO Karen Parchell spent a lot of time on the call talking about their cost mitigation playbook. How exactly does a company like HP defend its margins when global silicon prices are surging?
Well, it requires a total masterclass in supply chain management. If memory prices spike and HP does nothing, their 5% margin just vanishes overnight.
So what's the playbook?
It's a multi-pillar strategy. The first pillar Parkhill mentioned was strategic inventory.
Meaning they hoarded parts?
Basically, yes. Their procurement teams saw these price hikes coming months ago. So while parts were still cheap, HP bought massive quantities of memory chips and just physically warehoused them.
Okay, so they insulated themselves by using cheap parts they already owned. But carrying that much inventory is risky, isn't it? If demand drops, you're stuck with a warehouse full of depreciating computer chips.
Exactly, which tells you how incredibly confident they were in their demand forecasting.
What's the next pillar?
Certifying lower-cost components. Their engineers aggressively tested slightly cheaper parts from different suppliers to see if they could use them without ruining the laptop's performance.
Smart. And then there's the third pillar, which caught my eye. Demand steering. What does that actually look like in the real world?
It's basically behavioral economics applied to their salespeople. Remember, HP sells through a massive network of channel partners and distributors.
Right.
So demand steering means HP changes the financial incentives and rebates for those partners. They basically pay the salespeople more money to push the specific laptop models, where HP currently has the cheapest component costs.
Oh, wow.
Yeah, they gently steer the customer toward whatever SKU is most profitable for HP that week.
That's brilliant. And then the final pillar of the playbook is just the blunt instrument, targeted price increases.
Yep, just passing the cost right onto the consumer.
But this is where I really want to push back, because I was reading the Q&A section of the transcript. And management admitted something that raised a huge red flag for me.
The pull forward demand.
Yes. They admitted that 2% to 3% of their commercial PC revenue this quarter was from pull-forward demand.
Right.
If enterprise clients are only buying laptops today because they know HP is raising prices tomorrow, then they aren't going to buy laptops next quarter. Aren't they just robbing Peter to pay Paul?
Your skepticism is 100% warranted here. That is the exact definition of pull forward demand. HP signaled to the market that prices were going up.
So the smart IT managers scrambled.
Exactly. A CIO who was planning to buy 5,000 laptops in September says, hey, let's just lock in the purchase order right now in May while it's still cheap.
Which artificially inflates Q2's numbers, but creates a massive pothole for Q3. Because those guys are fully stocked now.
Right. They sold demand from the future to make today look better.
Which naturally brings us to Section 3, management guidance. We know they pulled demand forward. We know component costs are still rising. What on earth did Karen Parkhill tell Wall Street to expect for the rest of the year?
Well, let's start with the good news because they did actually raise their full year guidance.
Wait, they raised it despite all these headwinds?
They did. They narrowed and lifted the expected EPS range to $2.90 to $3.10 per share.
Raising guidance while component costs are surging is a pretty aggressive signal of confidence.
It is. And they also reiterated that they expect to generate between $2.8 billion and $3.8 billion in free cash flow this year.
We have to pause and emphasize why free cash flow is the ultimate truth-teller metric for a business.
It really is.
Earnings per share can be manipulated with accounting tricks, depreciation, tax stuff, but free cash flow, that is the actual hard cash left in the bank after paying every employee, every supplier, and keeping the factory lights on.
Cash doesn't lie.
Exactly. $3 billion in free cash flow means HP is operating as an absolute financial fortress right now. They can use that to pay their dividend, buy back stock, fund AI research.
And they are actively making that fortress leaner, too. They confirm they are on track to deliver $1 billion in annualized cost savings by 2028.
Didn't they just do an early retirement program?
Yeah, that locked in a big chunk of those savings this quarter. It lets them trim headcount without doing those really disruptive mass layoffs.
Okay, so the balance sheet is strong and annual guidance is up. But the tone definitely shifted when they talked about the immediate short term.
Oh, noticeably. Karen Parkhill gave some very stark warnings about the next 6 months. She basically told the market to expect a grueling third and fourth quarter.
Why? Is the playbook failing?
The cost mitigation playbook is just running out of steam. That strategy of using warehouse cheap inventory only works until the warehouse is empty.
And they've burned through it.
Exactly. Moving into the back half of the year, they have to buy parts at the current, much higher spot market prices.
And it's not just silicon either. They talked about broader inflation, like oil prices are going up.
Right.
And you might wonder, why does a laptop maker care about crude oil? Because oil makes resin. Resin is the plastic they use for printer chassis, ink cartridges, laptop cases.
Plus, higher fuel costs mean shipping those heavy printers across the ocean costs a fortune now.
So because of all this expensive silicon, pricey resin, High Freight Rates Management issued a direct warning.
Yeah, they explicitly said that operating margins in the personal systems division are going to compress and hit a low point in the fourth quarter.
A margin trough.
Right, before hopefully recovering in 2027.
And this brings us to the grand contradiction of this entire deep dive. This is that financial alchemy I mentioned at the very beginning.
Let's hear it.
During the Q&A, analysts were grilling them about the overall PC market, and HP agreed with the consensus. The total addressable market, meaning the total volume of all computers shipped globally by everyone, is projected to decline by high teens in the second half of the year.
Nearly a 20% drop in volume.
Exactly. So I pose this to you. The market volume is shrinking by 20%. Component costs are surging, yet HP raised their annual profit guidance. Mathematically, how is that possible?
It seems completely impossible until you realize HP has fundamentally changed its business model. Their strategy is no longer about selling more units. It is entirely about selling better units.
Quality over quantity.
Exactly. Since they know the total volume is shrinking, they are aggressively abandoning the cheap budget tier of the market. They are shifting their entire mix toward premium, high-margin AI PCs and Z workstations.
Oh, I see. It's like an airline realizing fewer people are flying this year. So instead of cramming more cheap economy seats into the plane, they rip out the economy section entirely and just fly a plane full of first-class passengers.
That is a brilliant analogy. Even if you sell fewer total tickets, the revenue and profit per flight goes up. They are intentionally trading empty, unprofitable volume for a highly lucrative margin.
And the proof that it's working is their pricing power, right? They raise prices to cover those component costs, and enterprises still bought them.
Yes. If you can hike your prices and the Fortune 500 CIO still signs the check because they desperately need secure local AI processing, you have decoupled your financial success from sheer volume.
You control the market instead of being a victim of it.
Exactly.
Well, we have covered a ton of ground today. The historical context, the mechanics of edge computing, the Windows 11 forced march, and this wild paradox of shrinking volume but rising profits.
It's a lot to digest.
It is. So let's bring it home with section 4. The bottom line, what does this dense earnings transcript actually mean for the retail investor listening right now?
Give us the actionable takeaways.
Based on all the data, our stance today is cautiously bullish on HP's long-term structural transformation. They are positioning themselves incredibly well for the next decade of localized AI.
No.
But we have to issue a firm brace for impact warning for the immediate short term. Management literally looked Wall Street in the eye and said profitability is going to get worse before it gets better.
So let's break that down for the listener. If someone already holds HPQ stock, how should they play this? If you already own it, your main takeaway is reassurance. Your dividend is incredibly safe. This company is going to generate $3 billion in free cash flow, regardless of short-term memory prices.
Right, the cash engine is solid.
And the structural tailwinds are huge. The AI edge computing shift is real. And the remaining 30% of the Windows 11 refresh guarantees steady demand for the next 12 to 18 months.
Plus, they prove they have pricing power.
Exactly. That's the hallmark of a resilient stock. You are basically being paid a handsome dividend to just sit patiently while they execute this transition.
Okay, flip side. What if a listener doesn't own the stock? They're hearing this, they love the edge computing narrative, and they want to buy in. What's the play?
My advice: extreme patience. Management just handed you a literal map of the next 6 months, and they drew a giant red circle around the fourth quarter labeled margin trough.
And Wall Street algorithms are notoriously brutal when those margin troughs actually arrive.
Oh, they will punish the stock.
Yeah.
And we also cannot ignore the huge uncertainty around the leadership vacuum.
Right. Bruce Broussard is just the interim CEO.
He's doing a great job keeping the ship steady. But the board is actively hunting for a permanent leader. Broussard even outlined what they want. Someone with a track record of value creation who can manage a highly complex global portfolio.
And until that person is named, the stock has an inherent risk premium.
Exactly. Because when a new permanent CEO arrives, what do they usually do?
They clear the decks.
Yes. They do a kitchen sink quarter. They take massive write-downs on old inventory, restructure underperforming divisions, or change the dividend policy to fund their own new vision.
So if you're looking to buy, keep your powder dry.
Wait to see who the board picks, wait for their new strategic vision, and crucially, wait for that Q4 margin dip to actually hit. If you're patient, you might get to buy into this AI hardware transformation at a much cheaper valuation.
That is the definition of actionable insight right there. Protect your capital from the immediate turbulence, but retain the long-term AI upside.
Exactly.
Before we wrap up, I want to leave you, the listener, with a final, somewhat provocative thought to just mull over.
Let's hear it.
For the past 2 years, the absolute consensus narrative in tech has been that the AI revolution would be won exclusively in the cloud. The market essentially crowned the hyperscalers, the companies building massive server farms in the desert, as the only winners.
Right, it was all about the cloud giants.
But if you listen closely to what enterprise customers are actually demanding right now, a totally different reality is emerging. The crazy token costs, the latency issues, the terrifying security risks of cloud AI, they are actually triggering a massive renaissance in local physical hardware.
It's such a profound paradox. The more advanced and complex cloud AI gets, the more desperately enterprises need incredibly powerful, localized edge devices just to interact with it safely.
Exactly. The physical computer sitting on your desk, which analysts called a dying legacy technology, is rapidly becoming the most critical piece of the AI puzzle.
It really makes you wonder who the ultimate winners will be.
Could it be that the quiet financial winners of the software AI revolution aren't just the cloud giants, but actually the legacy hardware makers putting the computing power back under your control? It just proves that in the stock market, the obvious narrative is rarely the complete story.
Well said.
Thank you all for joining us for this deep dive into the source material. We hope this helped translate the Wall Street jargon into clear, actionable intelligence for your portfolio. Keep a close eye on those Q4 margins, watch the CEO search, and we will catch you next time as we continue to unpack the forces shaping the markets.